All right. Good morning, everyone, and welcome to this year's first session of Cashflow Mastery Talks with Cashflow Mike. I'm Cheska Cordero from Insightful Accountant and your host for today. Now, actually, before we start, as usual, I would like to go ahead and ask a question of the day, just as everyone's coming in and settling down in front of their computers or phones or tablets. If you're in your car, be safe. I don't have anything in mind yet, actually, for a New Year's resolution. I know it might be a really generic question, so I kind of want to just go and ask around, get a few ideas. So, Mike, do you have anything up for your New Year's resolution?
You know what? I'll tell you what, I'm losing weight, right? Something happened
Fantastic.
in COVID. I know that sounds cliche. That sounds like what somebody else already does. I'm down 7 pounds this month
Oh,
alone.
wow.
7 pounds already. So I'm going to look trim and fit and beautiful again.
No, you're always beautiful. All right. Well, since we have that down, I might think about going back to the gym. No, I'm skinny, but I kind of want to get a little bit of muscle back. But anyway, good morning again, and welcome everyone to this year's first session of Cashflow Mastery Talks with Cashflow Mike. Again, I'm Cheska Cordero, your host for today. And in this session of Cashflow Mastery Talks, we'll be going over cost control and expense management, streamlining your business operations with the amazing Mike Milan. Now, I'll have him introduce himself in just a little bit after I cover a few of the housekeeping items. There is actually no CPE for this, as it is just a 30-minute webinar. If you have any questions, you guys know the drill. Please put them in the Q&A panel. I want you guys to be specific. Don't just say, what do you mean? You got to ask, hey, Mike, what do you mean by you want to go back to the gym or you want to lose some weight? Maybe, well, not maybe, mainly because he might not get to your question right after you put them in the Q&A panel. Now, we will be sending you a link to the recording right after the webinar, and it's also going to be up on our YouTube page within about 24 hours. So if you want to go check that out over there, you'll also find many other webinars along with Mike's past sessions of Cashflow Mastery Talks that might be of interest to you. I'll also be putting that link right into our YouTube to the YouTube channel right into our chat, as well as a copy of the slide deck. And I will be rolling out that link and the copy of the slide deck throughout the webinar in case you guys might have missed it. All right. Well, actually, that's it for me, Mike. Welcome and thanks for being here. Happy New Year.
Happy New Year. Hey, thanks for setting this up. I appreciate it. This is quickly becoming something I love to do every month is join Insightful Accountant and talk to y'all. So without further ado, live from San Antonio, it's Cashflow Mike. We're going to talk about all cost control, expense management, learning the rule that can't be broken. So why am I doing this? Right? And Kathy, I saw your comment. You crushed it. You are certified CPCP. Nice job getting the year started off right. So why am I doing this though? Because I am on a mission to eliminate cash flow as a reason that businesses fail. So if you want to help me with that, pay attention. Let's do this together. These are simple, easy to use concepts that all of us can put to use in our practices with our clients, with any business. Here's why. Bankruptcies are starting to rise again, right? They're starting to rise again. They dropped right after COVID. They went up to COVID and then they started dropping again. And now they're starting to climb. Over the last part of 2023, they increased almost 23%. And we're getting about 15,000. That's better than the 50,000 we used to get. The thing that always gets me is that this is what bankers tell me. Bankers tell me that about 35% of the people that file for bankruptcy also have profit on the book. So it's always confusing to people. I'm making money. Why can't I pay my bills? These are tactics, tricks, tips, and traps to avoid to be able to increase your cash flow. I'm focused on that. It's not about profit. It's about putting money in your bank account. So here's the rule. Let's start off there, right? In my course, The Clear Path to Cash, I teach a rule called expense control. Right. And it's one rule to rule them all. It's the one thing that I talk about very specifically is if you violate this rule, your company will die. It cannot live or sustain life if you keep violating this rule. And the rule is simply this, right? If you have less money to spend, you should spend less money. You're like, Mike, I didn't come on here for 30 minutes just for you to tell me this. There's no way that, you expect me to just believe if I have less money to spend, I should spend less money. Yeah, I do. I do. Even though you think about it, even though you know it's true, most of us, when it gets into the heat of battle, and the heat of battle to me is I go to work every day, I just grind out. I'm helping customers, I'm promoting my business, I'm trying to grow my business. All of these things, I forget about the basics. So I want you to remember this basic things. If I have less money to spend, I should spend less money. Now, in accounting world, we think about this differently. We don't think about I have less money to spend and I should spend less money. We use different words. The words we use here is money to spend. That's gross profit. And if you've ever heard me talk about it before, gross profit is the most important number on the income statement. It is the only place you can get cash to either spend on your operating expenses or put in your pocket, right? So gross profit is the money you have to spend. Spending less money, that's operating expenses. That's how we spend it. So that's what we're going to be talking about is how much money do I have to spend versus how much do I spend? The operating expense versus cost, gross profit. So here's the rule in expense control, right? That the change in operating expense should mirror the change in gross profit. All right, let me say that differently. Gross profit is the amount of money we have to spend. Operating expense, well, that's how we spend it. If I have less money to spend, I should spend less money, meaning the same, about the same. If you took a $2,000 a month pay cut in your own household, would something have to change? Right? That's what I always ask my clients. If you take a pay cut, do you have to change something about the way you live? Maybe you're not going to Taylor Swift concerts anymore. Maybe you're not going, taking a trip like you used to, or you're not saving as much or spending as much. Some people might not even be able to cover their bills. It doesn't matter. Something has to change when the money coming in changes. What we normally do in our house is reduce our spending, so we're still managing within our means. Why are we not doing that in the business? The business has the same needs. It has the same, things that are happening. We're spending money off the money that's coming in. So when we graph a company, generally, I kind of look at it this way. I kind of graph it like over time, we'll see sales go up and down. And this is how we determine whether or not we should cut expenses or not. So if I graph sales over time in about any company, you'll see that sometimes they have a growth spurt and then maybe it levels off and then it tails downward, kind of ebbs and flows. That's kind of how sales happen in a company. And if we're doing it right, our gross profit tends to go along with it. When I say doing it right is a successful business owner will manage their business according to the gross profit margin, right? Meaning they're pricing their goods to achieve a certain amount of money. If I want 50% gross profit, that means for every dollar that comes in sales, I have 50 cents to spend on other things. That's what I'm talking about. They tend to move together. What's interesting is that operating expense doesn't do that. Operating expense tends to move like this, stair step. Why? Anybody know? Kathy, you know why? You're certified. Why does operating expense tend to move like this? You can put it in chat. If you know and you think you know, just put it in chat. The reason why is that as we're growing, things are happening around us. Our business is growing. We have to do different things to keep up with the growth. As we're moving on up, our employees start to get more stressed because they used to do, and I'll annotate on here, they used to do work at this level. Now they're having to do work at this level. And what happened is, and you'll feel it, your employees will go, if you don't get me some help, I'm quitting, right? Well, that's what we don't want to happen. So what we normally do is we will run it for a little bit and then we'll add an employee or we'll add a location or we'll add a new truck, whatever it is that we're trying to add to keep up with the business growth. That's why business expenses tend to go up. We're trying to keep up with what we're growing and we're adding new processes or new we'll say software subscriptions, whatever it is to keep up with the growth, to keep up with what we're trying to achieve. Well, the reason why it flattens out is that once we've added the asset, the person, the truck, the location, after we've added the asset, we tend to keep it flat for a period of time, because the longer we do that, the more money we make, right? And this here is the amount of money that we make right in there. When our operating expenses are less than gross profit, we make more money. We keep it flat because the longer we can do that, especially while gross profit is growing, we make a lot more money. That's why we tend to do those type of things. Well, here's what happens in real life, though. In real life, we tend to not annotate anymore. Can I get rid of that? There you go. We make money there. We tend to level out even when gross profit starts to come down. And you notice the difference between here and we'll say here. Look at that. I have less sales, but where did I make more money? I made more money when I had less sales than I do now with more sales value. It's because I'm not practicing expense control. I've let my expenses continue to climb even when gross profit was starting to come down. Well, when that happens, the smaller this gap is, the less money that we're making to be able to spend. If that's true, sometimes this part happens, right? Where operating expenses and gross profit are the same. The amount of money I brought in gross profit equals the amount of money I'm spending in operating expense. That's called break even. I like to call it practice and working, right? Because we're not doing it for money anymore. We're just going to work and doing our job and nothing's happening. We're not making money. We're not losing money. We're just practicing doing our job. So that's one of the things that I like about that is, if here is where we need to make that decision, should we cut expenses? And it should be back here. We should be making that decision. But at least at this part, it's the first physical thing is, hey, we're getting ready to lose money. We need to cut expenses. We need to look at what we're doing a little bit more seriously. And Kathy, good job. Certain expenses are fixed. Won't be spreading those costs over more sales. Okay, I get it. And I need to get rid of that. Okay. So when this happens, we have to make the choice of what to do next. But some of us don't. Some of us will continue on keeping our expenses at a higher level, even when now gross profit has dropped below how much money we're spending, right? That's when we're starting to lose money. We make money over here, we lose money over there, right? That's kind of how that works. When I was a state trooper, and some of you heard this story before, but when I was a state trooper, people used to ask me all the time, they say, Mike, how fast can I drive? That was the most common question I ever got in the world was how fast could I drive? And my answer to them was always the same, no matter who asked it, because I thought it was funny. And some people out there will go, oh, he would say, sir, you should drive the speed limit, right? No, I'm not that type of guy. I'm a little bit more funny. I think I'm more funny than that. So I would always tell people, you can drive as fast as you can afford, right? If you can afford a night in jail, I'll give you that. If you can afford, a $50 ticket, I'll give you that. You get to determine how much you can afford by how fast you want to drive. It doesn't matter to the police officer. He's just going to give you whatever it is that you can afford because you drove that fast. Well, the reason I tell you that is the same answer holds true for this situation. How long can I continue to operate with my operating expenses over my gross profit, spending more than I'm bringing in? Well, as long as you can afford it, right? And then your company dies because you run out of money. And it happened to a friend of mine in Lake St. Louis, Missouri in 2003, 2004. His dad gave him some land to develop out around Lake St. Louis. And by 2005, he had almost 35 houses that were up or being built in this subdivision. And one of them was his own. Well, the average house price at that point in time in St. Louis was around $300,000, $350,000, somewhere in there. And he built himself a $1.5 million home. I mean, this thing was massive. It overlooked the lake. It was a monster among all the other smaller houses. It had everything. It had an infinity pool way back when. It had granite. It had a putty green. I mean, all of these things that we kind of expect now, he had them then before we all did, right? So in 2008, he gets worried about what's happening with the market. The bankers had just burnt the world down, and he's worried about, what's going to happen next in his business because he's still trying to develop all this land. Well, he asked me, he goes, Mike, what are you going to do? At the time I had hotel staffing companies and I had 3-bar restaurants. And I said, I'm cutting labor, right? I mean, that's one of my biggest expense. And as people attrit out, I'm either not going to replace them or I'll replace them with part-time workers. One of the two, just depends on how it is. But I'm going to bring down expenses in the form of people. And he goes, yeah, I can't do that. I got to keep my crews. I got to keep them going. So what we're going to do, Mike, is we're going to keep all of our crews in place, but we're sitting on a bunch of cash from these other houses that we already built. And so as the bottom drops out, as people start to lose their homes and the value of homes start to come down, we're going to go buy up these undervalued assets and we're going to accelerate growth in our own company by buying up these assets, right? And I'm going to have the crews already in place to be able to go finish projects or do whatever, but we got the cash. Believe it or not, that's actually a strategy that works. When you think about it, it's a strategy that works. It's a strategy that some people employed and made a lot of money through the crash of 2008. He wasn't one of them. He thought he had a lot of money until he couldn't figure out when the bottom was, right? He couldn't figure out where it was to buy and how long it was going to take to recover from it, where after he bought the asset, he had to sit on it for a longer period of time because nobody else was buying either. Well, when that happens, he just keeps burning cash, burning cash, burning cash until he has none. By 2009, he started losing homes. By 2011, he lost his own home. By 2012, he was selling mortgages in a strip mall. So I tell you that because this is a tale of caution. This is so when you're talking to your clients saying, listen, we can do this, but not very long. We're going to eventually have to make a change. And the change in this case, if I just give you an example, we have maybe a company that cuts $450,000 in gross profit, meaning gross profit comes down, it starts to coming down. We've lost $450,000 period over period. Well, if we only cut $350,000, the result is a loss, right? $100,000 loss. We had $450,000 less to spend. We only cut $350,000. The difference between those two comes out in profit. Whose profit? Your profit, your pocketbook. That's where it comes from. So when you see this, you need to make the cut and you need to make these two numbers equal. So when you make the cut, you bring it down to the same level, 450 to 450, right? The change in operating expense should mirror the change in gross profit. When you do that, it doesn't matter what sales level you have. You can make the same amount of money regardless of the amount of sales that are coming in. When you see this, these huge cuts, this is when you see the headlines in the news. Meta lays off 7,000 people. Well, how did they come up with 7,000 and not 10,000 or not 2,000? Why is it 7? Well, because this number, 450,000 or whatever number they're trying to achieve, has to be 7,000 people's salaries worth. They know that they have less gross profit, so they cut the same amount in operating expenses to make the same money. They can make the same money that they used to. Here is the same money that they used to there, right? They're trying to make the same money. You're like going, Mike, I don't know if I believe you. I don't know if that works. It sounds good on paper. It sounds good, in the PowerPoint, but maybe it's not for me. Maybe I don't see the math as well. Well, this is where I'm going to show you why it works, right? This is just a sample income statement. If you look at the way I look at this is a mini P&L, right? It's a technique I teach in the Clear Path to Cash is to use a mini P&L to kind of solve these problems, right? It clears the noise. It takes out all these other little charts of accounts and things like that and helps you focus on what matters in your business, right? The main categories. If there's a problem in a main category, we know where to go look because we can see it. Well, in this case, if we had $10 million in sales, or this could be 10,000, it doesn't matter, zeros or zeros. And we get 50% gross profit. That means our cost of goods sold is 5 million. and gross profit is 5 million. I'm doing this for easy math, right? So we can follow along in the presentation. So we got gross profit of 5 million. Our operating expenses are 4 million, which gives us a net profit of 1 million. That's our baseline. That's what we normally do. Well, let's say we're on one of those cycles where sales is slipping. Sales are coming down. So in year 2, when we look at it, we only got $9,100,000 in sales. Keeping the same formula, 50% of it is cost of goods sold, 50% is in gross profit. Now, we cut operating expense, but we didn't cut it by enough, right? We just cut it, or we think we cut it enough. We don't know. And the result is this: we have $100,000 less in net profit, right? So the only thing that happened is we sold less, we saw it, we cut expenses, but look, we didn't cut enough because we lost money in the form of profit. So when I look at the change now, I'm all about kind of the change between periods. Nothing happens in a silo. These things happen in overlaid stacks. They're concurrent. They happen kind of with each other and in a long stream of consciousness. Well, in this case, the change in sales, it went down 900,000. The change in cost of goods sold went down 450, so did gross profit. The change in operating expense, so was only 350. Well, the difference between these two is 100,000, right? So that shows up in net profit. We cut expenses, but not enough, because the rule is the change in gross profit should equal the change in operating expense. And if you do that, you will not lose profit. Let me show you. If we exercise proper expense control, it'll look like this. We'll have same amount in sales, same amount in cost of goods sold, same amount in gross profit. Nothing changes. The only thing I've did is I've exercised expense control. Instead of cutting 3.6 million, I'm going to cut down to 3.5 million, right? Another $100,000. The same as 450. It went from 4 million to 3.5. I cut the same. Here, from 4 million to 3.6 is only 350,000. 3.5 is 450,000, right? You see how I did that? It was at 4. I cut 450 equals 3.5. When I do that, I make $1 million. 4.5 minus 3.5 is $1 million, which is kind of cool because at $10 million, I made $1 million. And at $9.1 million, I made $1 million. The math is simple. The rule is clear. The change in gross profit should mirror the change in operating expense. If you do that, you should be able to make the same amount of money no matter what sales. Just follow that rule. All right. That's something in the chat I saw. Operating expense needs to be reduced by 900. Yeah, Larry called it out before I even did it. I went through all that exercise and Larry already knew the answer. So what do I cut? All right. Well, when I'm talking to my clients, I start here. I'm like going, let's agree to some ground rules before we even look at an expense. Let's agree to something, right? First things I want to know is, do I need it or not need it? Now, you're going, Mike, that's too simplistic. Yeah, that's what we're trying to do. We're trying to get people to take action. The more complicated you make it, that's the more friction you're causing in the relationship between you and your client. So do I need it or not need it? And can I afford it or not afford it? Right now, we know most things we can't afford, right? But some things we're going to have to afford that we can't get rid of. But this is where we start having to ask better questions of our client, right? So, I mean, do we need it? Do we not need it? Can we afford it, not afford it? But then, is there a better way to do it? Is there a cheaper way to do it? I found, in my clients, and the example came up this morning in my 8:30 meeting with our group, that there is a client I had that had a $3,000 a year subscription to a CRM that he was not using. Think about that. Here's a CRM that I don't use, which means you don't need it. He doesn't even log into it, but he pays $3,000 a year just because he can't figure out how to get the information out of it, right? As storage, he's paying $3,000 to store it. Think about buying a $3,000 trunk to put in old newspapers that you never go back and look at, right? and maybe they're never going to be worth anything because they deteriorate over time. He's never looked at it. He doesn't use that information, but he doesn't want to lose it, and he doesn't know how to get it out of the other software. It's not a reason to spend $3,000. There's a better way to do it. There are ways to export information. When we looked at it, we showed him how to do that, how to export it, put it into just more drive storage, $299 a month for more Google or more Apple storage or Microsoft storage, get you all the storage you need for everything you had in CRM. So when I say let's find a cheaper way to do it, let's be honest enough with each other to say, is this the best way to do it? Because some of us have processes and things that we put in place 10 years ago where technology now makes it easier. Technology now makes it cheaper. So look at everything with a critical eye to be able to say, do I need it? Can I afford it? Is there a better way to do it? Those are the three questions. So here's the way I do it with my clients. I take just the basic profit and loss. But when I set it up, and if you go to QuickBooks, this is real easy to do. I'll take a period over period view. So compare to last period, and I'll take the two variances. One is in dollars, the other is in percent. This is how I set up an Excel spreadsheet for them. And then what I'm doing is on this side is I start asking the questions, right? So first of all, I ignore all this. So I hide every row between row 6 in this case and row 18. I just hide it. And I get them to focus on the bottom. I don't care about sales at this. We're doing cost analysis. So when I get them to focus on the bottom, I just pull this up big, right? And hide everything else. And then I go into this. I'm going to identify where are the large changes in percentages first, right? So I'm going down through here. And of course, this is sample data, so it looks weird, but I'm going to look for the large changes, like down 100%. That seems good, so I don't need to really do anything with that right now. But all these other ones are up 100%. Well, the second thing is, if it's up 100%, I'm now going to identify the large changes in dollars. Well, that's up 100%. This is up 100%. That's $600. That's $1,700. The first thing I'm going to start talking about is total Google ads, everything here. Is this worth it? Is this driving our revenue? Because the things you don't want to cut are the things that drive your revenue. For instance, in a bar that I used to have, well, one of the biggest expenses outside of labor is entertainment. Think live bands, think karaoke, think pay-per-view television, fights, UFC fights, direct ticket, Sunday ticket. All of these things cost money, anywhere from $3,000 for a quality live band for a night down to, who knows, $150 a night for karaoke. All of that is money that comes out of the register that day, right? You are pushing it out of the register that day. Here's the thing. That's also the reason why people are coming to your place. So if you stop that, you're also taking away people's reasons to come visit your business. So when you're doing cost analysis, do not cut the things that drive your revenue, or you're going to cut your revenue at the same time. Look for things that don't produce revenue. Look for things that you think are efficiencies or nice to have, but if they're directly related to revenue, try not to cut those. Now with ads, some people will use a calculation called return on ad spend, but they'll stop at the total, right? They'll go to the total return on ad spend was $14 for every dollar I put in ads, $14 comes back. I make my clients go a little bit deeper. Let's look at Google ads, ads for QuickBooks, ads for Xero. I'm going to look at those individually and says, do I really get money from this? And if not, we're going to cut it and divert that money to something else that works. So look at every single place that the money goes out to be able to make that change. But this is the way I do it. Last year versus this year, percent change, dollar change, ask the tough questions. Why is it there? Should we cut it? Is there a better way to do it? That's what we're talking about. Okay, another good 30 minutes with Insightful Accountant is in the book. Expense control is all in my book, The 7-Minute Conversation. If you go to cashflowmike.com, you can get a free copy of it just right below the header video. Download a free copy of The 7-Minute Conversation. I've got a free Facebook group called The Clear Path to Cash. Lots of tools, lots of spreadsheets, lots of resources. People like Larry and Kathy are in there as group experts. Come see them, Dawn as well. listen to my podcast. It's Mike and Blaine, right? Mike and Blaine, we talk about business, beer, and BS. So if you listen to podcasts and you want to know more stories like this, go check it out. Mike and Blaine is where we're at. Mike and Blaine, business, beer, and BS. And then if you want anything, right? If you want to learn more about what I do, just email me at mike@cashflowmike.com. So I appreciate y'all. I'm grateful for you for hosting, and I'm going to turn it back to you.
All right. Well, thanks so much, Mike. And thanks everybody for coming to this year's first session of Cashflow Mastery Talks. We hope to see you again next month for our next session in February. Thank you, everyone. Bye. Have a good day.
Now, appreciate you.